Um, thank you all for being here. And I know that there's still some people who are joining. I know that 5 o'clock is right after work, and so it takes people a little bit of time, but thank you. We are really excited tonight to have Clark Williams-Derry with us. I'll read you his official bio. He served for 18 years as the Director of Energy Finance and Research for the Sightline Institute. It is a multi-issue sustainability think tank based in Seattle, where his research focused on US and global energy markets, and he was a senior analyst for Environmental Working Group. He is now with the Institute for Energy Economics and Financial Analysis. I remember the first time Durf and I came across his name, he had written something about signal peak energy, and you may not know it, but MEIC had a great victory this week in the Ninth Circuit Court of Appeals on signal peak. But the first time we read it, I remember Durf ran into the office and said, "Have you seen this?" And Clark at the time was with Sightline, and he had done a deep dive on who was responsible for that mine and their coal export scheme. And we hadn't seen a lot of the research he came up with. And so in our mind, he was a bit of a rock star. He wrote a lot about Cloud Peak Energy and their Spring Creek mine in Montana and their coal export activities and what they were doing. And everything he said came true. You know, it wasn't profitable. They ended up going belly up. They declared bankruptcy and are now owned by a different company. And when we first met him at an IEEFA conference, when he was still working for Sightline, I remember Durf tapping me on the shoulder and saying, "Oh, there's Clark. We need to go meet him." So we've been really relying on his work at MEIC for a very, very long time. So when we saw his name pop up the beginning of the Russian invasion of Ukraine and the spike in gas prices, we called him and we said, "Hey, we have this idea." And he was into it. And what we heard from him on that conversation was so interesting. It was just a fresh perspective on what's really going on with gas prices in this country in terms of economics. And it's not necessarily what we all want to hear, but it is exactly what we all need to hear, because it's accurate information about what all of the high gas prices really mean, or what they don't mean. So I am going to turn it over to Clark, and I just want to say thank you to him for so many years of amazing research. We love IEEFA and everything they do, and we're so thrilled that you are still working in a space in which we can rely on the data you generate.
That was very sweet. I think of you guys as the rock stars. So just to hear like my idols telling me that I'm a rock star, that feels pretty good. And actually, funny thing about that signal peak connection, what I uncovered was that there's actually a Russian connection to the signal peak mine. That it was originally, one of the owners was a company called Gunvor, which was kind of a private piggy bank for Putin through a proxy named Gennady Timchenko, who's already he's also been sanctioned under the recent. I can go on for a while. I'm going to stop, and I'm going to actually share my screen for a little bit and sort of just explain to you a little bit about what my research has been showing about high prices for oil in particular, not necessarily gasoline, but oil in particular, and also kind of like this bizarre gap between hype and reality, or between what people are saying about high oil prices and the oil industry's kind of reaction to high oil prices, and what's actually going on. Now, everything right now in the energy world is being sort of filtered through Ukraine. I mean, Ukraine is the lens through which all conversations about oil and gas are being refracted. But in a way, from the oil and gas industry's perspective, it doesn't really matter whether the cause of high prices is Ukraine, or if it could be like, Saudi Arabia or some other global crisis. Really, for them, it's an issue of high prices and how they're responding to high prices. So the thing, if you look at what the oil industry, or in particular, the oil industry lobbyists are telling to Congress or telling to the public, you'd think that they want to respond to high prices by producing more. I mean, like, the way they talk about it, the industry just wants to produce more oil and gas, and they want to do that so they can help bring down prices and bring the high prices under control, that sort of thing. But according to their story, they really can't bring down prices. They can't produce more because of all this political interference. The Biden administration, or let's say like another popular sort of target is ESG investors. ESG stands for environment, social, and governance. So these are investors who maybe care about something beyond just the bottom line, or maybe think about environment and social governance issues as a way of getting at the bottom line, of better understanding and predicting the bottom line in the long term. But obviously, fossil fuel investors or fossil fuel companies kind of get short shrift from a lot of ESG investors because of their obvious impacts on emissions and some of their sort of lack of transparency and then good corporate behavior. But so they complain about politics, they complain about investor trends that are against them, and of course the answer to all this in their mind is, let's ease regulations, as it always is for the oil industry. Let's ease regulations. Let's approve more permits. Let's approve more pipelines. Let's approve more leases. That will help us bring prices down because we're the good guys. We're on the side of consumers. All we want is just, we want to be able to produce more oil and gas to help, ease the shortfalls in the markets and bring prices down for consumers. All right, what does the oil industry actually tell to its investors? Now, this is a key thing to pay attention to because the oil industry can tell, or their lobbyists can say anything to the public. There's no sort of there's no stigma attached to sort of misrepresenting the truth. There's no downside for them to that. But you can't lie to your investors. If you lie to your investors, there are penalties for that. So generally speaking, one of the ways that I've figured out what the oil industry is actually saying, what it's actually doing, what its actual plans are, is to read what they're saying to investors, not read their press releases and the press releases from the American Petroleum Institute. Actually read through the 10K filings and the 10Q filings. These are the big SEC filings that tell investors what the company's plans are, or listen to the investor conference calls. So what is the oil industry telling to its investors right now? Well, first of all, probably most importantly, the industry is finally making money. And this is one of the big dirty secrets that I'll get into later in this presentation. The big dirty secret of the fracking boom was that the industry was producing plenty of oil and gas in the US, but it was not profitable. It was not making profits. You could make barrels of oil, they couldn't make cash. So they're telling the industry now with these high prices, or telling investors now with these high prices, the industry is finally making some money. And probably just as importantly, it's using that money to return cash to investors, to pay down debt, to pay dividends, to arrange and organize share buybacks, anything they can do to sort of basically funnel that cash out the door to investors. What else are they saying? High prices have been very good for their profits. I mean, that they're now more profitable than they've been in years. They also are saying very clearly that the idea of drilling more and ramping up production right now doesn't make sense for them. It doesn't make economic sense for them. It's expensive to drill right now in a time of high inflation for things like steel pipes and that sort of thing. It's especially expensive. But just as importantly, if they ramp up production quickly, as they have in the past, if they start to another production boom, another sort of big fracking boom, it could bring down prices. And that basically sort of killing the goose that laid the golden egg. The scarcity, concern about scarce supplies, that's what's raising prices. If they ramp up production rapidly, they could bring prices down again. And lastly, another thing you hear pretty consistently is that, even if the industry wanted to produce more, even if they thought, now's a great time, we're going to ramp up production, they're facing constraints. They're facing bottlenecks. They're having a hard time getting frac sand and labor and the piping that they need, basically sort of well casings, all sorts of things that they would like to be able to, like if they wanted to, drill more, if they wanted to produce more for oil and gas, they would have a hard time because they're facing severe supply chain bottlenecks, just the way the rest of the world is facing. Now, of course, a lot of this talk it's kind of in veiled Wall Street language. It's kind of like Wall Street code that's hard for outsiders to understand. So, for example, you might listen to them, talking about, oh, we're going to be exercising capital discipline, which sounds like, well, sounds all very good, but they say that instead of saying what they really mean, which is we're going to be spending less on drilling. Or they may talk about phasing in production targets rather than we're not going to grow. We're going to grow slowly, if at all. Or they may talk about sort of maintaining margins, profit margins, or maintaining margins rather than making a lot of money. So, if you hear it like in Wall Street, but if I hear them say something like, we'll be exercising capital discipline to phase in our production targets in order to maintain margins. And that sounds a lot better. It sounds a lot more benign than saying, we're going to spend less on drilling, we're going to grow slow, and we're going to make a lot of money, which is actually what's happening. So now the thing is that there's actually a handful of, I would say, sort of truth tellers within the oil industry itself. And you have to give them a little bit of credit because these are people who are basically speaking plain English about they're energy industry insiders or CEOs, and they're actually telling the truth in plain English about what they are doing and what their plans are. One company that stands out to me is Kimmeridge Energy Management. They have a couple of quotes around, but I thought this one's great. They're forthright. We are not a public service industry. We made no money for 10 years. Now that we're profiting for 2 months, you want us to give back the money? No. We are so they're very clear about this. Pioneer's CEO, Pioneer Energy, or I guess it's Pioneer Resources. Goodness, I've actually forgotten. I think it's Pioneer Resources. Got to have to change a slide deck. It was very clear in an interview with Bloomberg. It's all about our shareholders. Our shareholders own this company. They want a return of cash. We know what's happened in the past. When we produced too much, prices came down, we had a collapse. So we're going to keep growth in check, and that's good enough because we're going to be able to keep funneling money back to our shareholders. So this is sort of the kind of the plain spoken version of the sort of the gobbledygook you hear on Wall Street. And I do actually give these guys a lot of credit for being forthright. It's they say that in many parts of the world, in DC and on Wall Street, a gaffe is when you accidentally tell the truth. And these guys are actually telling the truth all the time. They're making gaffes all left and right, if that's what it is. So I want to convince you just for a little bit that actually these guys are correct, that the oil and gas industry actually was losing money for a long time, and that they are right now taking advantage of high prices by keeping growth in check and enjoying profits. So this is a chart showing something called free cash flow. This is a chart we assembled by going through all those SEC filings of 10Ks and the 10Qs and looking at this metric called free cash flow. Free cash flow is essentially, it's a financial metric that looks at how much cash a company generates from its core operations. And for an oil and gas company, that's how much cash they generate by selling oil and gas versus how much they spend on capital expenditures, mostly like drilling, buying new acreage, locking in new acreage releases, and drilling, actually putting steel in the ground. And you can see down on the bottom, this is from 2010 to 2021. It may have happened before this. 2009 was sort of the Great Recession. 2008 was kind of crazy time, but so we kept it as simple and looked at 2010. And you can see that what the Cambridge Energy Management executive was saying is actually true. This is an industry that was losing money for most of the last decade. It was consistently spending more money on drilling than it could generate by selling oil and gas. It was doing a great job of producing more oil and gas, but doing a terrible job of producing profits, producing cash. And the numbers that are basically is it billions? This should be in millions. I made this slide deck at the last minute. I apologize. Should be in millions, not billions. But it's basically 2010. They spent 13 billion more on drilling than they could generate by selling oil and gas. And then in 2020, they spent $30 billion more on drilling, and then it kept going and going and going. And they gradually closed the gap. But it wasn't until COVID hit that they actually started to turn that around and actually went positive. And that is a surprise, because when COVID hit, that was when demand was down, when prices were low. This was a time when, like big parts of the world economy were shut down, flights were canceled, people were staying home. Large sections of Europe saw, massive declines in economic activity. And that's when the US industry started making money. And that's interesting. They learned something from that. What they learned, I think, was that by cutting back on drilling, they could actually generate cash, even as they were, even as prices were low, even as demand was low. By keeping drilling in check, they could actually start to reap the benefits of the wells that they'd already drilled, sell that stuff, make some profits, generate some cash, and really turn their operations around. And they kept that basically kept that up during 2021, where they were growing slowly. Prices were rising, they were drilling less, and they were generating cash. And by all indications, the first quarter of 2022 is going to be the best quarter possibly ever. And this is in the middle of high prices. And the reason is they've got high prices, and they're not spending as much on drilling as they have in the past. And that's precisely because they don't want to. They have a hard time with the supply chain bottlenecks, but they don't want to be spending that money on drilling. So this is only one way of looking at the financial failure of the oil and gas industry over the past decade. This is another. It looks at bankruptcies. There's been a wave of bankruptcies. And what basically a bankruptcy is, it's an orderly way to make investors unhappy, to make them sad. So during a bankruptcy, the equity, the stock value often gets wiped out. The debt gets written down or traded or whatever. So you go from $177 billion worth of debt down to just a fraction of that, because a lot of it just gets written off. Everybody agrees it's never going to get paid back. So, caught up in these bankruptcies, there's two big waves, one in 2016 and one in 2020, but it's been, a trickle even outside those years. There's been, since 2015, there's been $177 billion in debt that's been restructured, caught up in bankruptcy, which means a massive amount of wealth destruction, a phenomenal amount of money that just basically existed and then ceased to exist, essentially. Another way of looking at this is in stock prices. This is the S&P 500, sort of a broad stock market index. And on the top, and you can see, since, it's had a little bit of trouble recently, but since 2010, the S&P 500 is, it's almost 4 times as much. It's 4 times as valuable as it was then. If you sort of bought then and, and held on to a portfolio of stocks in the S&P 500, the value would be about 4 times what it is now. ExxonMobil, particularly since 2014, you can sort of see in 2014 that it actually, compared to 2014, the stock price is down now. But overall, there's been this big gap between the performance of the rest of the market and the performance of the S&P 500. There's, obviously ExxonMobil is doing better than it was at the depths of COVID. But if you look at over the long haul, the S&P 500, even since pre-COVID, which is right about there, right? I don't know if people can see my cursor. People, thumbs up if you can see my cursor. Right there is sort of the COVID shock. And the S&P 500 is there now. It's a lot more, and ExxonMobil was there and now it's there. So it's like, it's doing better than it was at the beginning of COVID, but the rest of the stock market's done a lot better than ExxonMobil has. Now, one other thing that I want to point out, and I'm not even sure why I include this slide, but I just thought it was kind of interesting. We talk about high prices now as if they're unprecedented, it's the highest ever. That's actually technically not true, because there was this big price spike in 2008, sort of right before the economy crashed. I don't know if people remember, but oil prices went sky high. Gas prices were all over the news. And this was just as the recession was starting. So, high prices in a recession led to collapse in driving. It was a talk about sort of, millennials rejecting cars and all sorts of other stuff. But so, in nominal terms, so the blue line here, prices were higher back then, but also in inflation adjusted terms, from 2010 through 2014, oil prices were regularly higher than they are right now. So this isn't to say that oil prices should be one level or another. It's just to put things into a little bit of a historical context that, yes, oil prices are high right now, but it's not unprecedented. We have been through this before. And when we've been through it before, we've seen, a bunch of things happen, including some demand destruction. That is, people choosing to buy more efficient cars. But also, we've seen that actually in the past, we've seen that high prices often trigger a round of new investment, which is not happening so much this time. Okay, so I also want to talk a little bit about this whole idea of energy independence, and the fact that the very notion that the oil and gas industry will be able to, by producing more, will bring down prices. So this is a chart that shows our monthly net imports. So when it goes up, it means we're importing more than we're exporting. And as it goes down, it means we're exporting more and more. And so what you see, and this includes both oil, and it includes things like gasoline, refined products, diesel, other kinds of finished oils. Right now, we are actually, if you look at in a volume terms, we are net exporters. The US is a net exporter of oil and oil products. And yet, our price is still tied directly to global markets. So producing more doesn't necessarily mean lower oil prices for us, because our prices, the US prices, are still basically following the global market trend. So this idea that we can export our way into some kind of boom, make production grow, and we'll wind up with lower prices here at home. Well, really, that it doesn't depend on what happens at home. It depends on an entire global dynamic of oil and gas production. And just producing more, because we're connected to the international markets, because the East Coast is still buying from international markets, and because we're selling our oil to the highest bidder anywhere in the world it'll go. Our price, the price we pay for oil in the US, is the same price basically as that's paid elsewhere, paid in global markets. Yeah, there are sort of minor price differentials due to quality of the oil and the location of the oil, but basically we're all following the same trend. So this idea of energy independence, we've seen this massive boom of exports and a massive boom of production, but we are as sort of yoked to international prices as we've ever been. Our prices hinge on their prices. So, okay, I'm going to turn to questions and answers pretty soon, because I'm sure people have lots and lots of questions. But I'm prepared to pretty much answer, talk about anything that people have to talk about. But so the question that may arise is, okay, the oil industry is saying one thing to the public and saying another thing to its investors. Why is it going to the trouble of doing that? Why is it going to the trouble of maintaining these two parallel lines of communication with the public? Telling Wall Street and the investment community, we're holding growth in check, and telling essentially the policymakers, you're the problem. It's not us. You're the problem, and you need to fix your the way you treat us in order for us to be able to produce more oil and gas. I mean, why are they sort of like telling sort of wildly different stories? Well, the first thing is kind of obvious. It's what industries do. They tell stories in order to create narratives, in order to get favors. The favors could be more tax breaks. Maybe they'll get some production tax break, and maybe they'll be able to sort of protect some of their existing tax breaks. I mean, the intangible drilling cost deduction, which is like one of these complicated IRS things, but basically allows companies to write off most of the cost of drilling or much of the cost of drilling a well in year one. It's like in most businesses, you can't do that. You have to sort of, if you have a capital investment that lasts for a long time, you sort of have to depreciate it over time. But the oil industry can, write down its taxes, write that stuff off as taxes right away. Or maybe they can get more approvals, or maybe, maybe in their wildest dreams, they could wind up with a government essentially guaranteeing loans to the oil and gas industry. This is an idea that gets floated from time to time, essentially a government loan guarantee to pay for infrastructure. If you've decided, look, it's important, it's necessary infrastructure, it's a pipeline, or it's an LNG export terminal, maybe you can get the government to de-risk the project, take on some of the risk of the project by guaranteeing that money is going to get paid back, so that the oil and gas companies, or the LNG companies, liquefied natural gas companies, can get access to money for cheaper, right? But there's a second reason here. I mean, it's not just about currying favor, asking for favors, or actually asking for special benefits. It's also, in my opinion, that they sense some vulnerability here in their position. With war and with high prices, they are making a lot of money. And it's got to be crystal clear to anybody who's looking at this that the interests of American consumers and the interests of the American oil and gas industry, they are not aligned. They are right now opposed. The oil and gas industry likes high prices, consumers don't like it. And so they don't want people to catch on to the fact, or they want to sort of distract the conversation, sort of like, I imagine sort of like, like any political debate, you sort of like, say something and make people look over there and look over there, look over there. They don't want anybody to be looking, at behind the curtain at what's actually going on. And the reality is that this is an industry that is very much enjoying high prices, very much does not want to spoil profits by overproducing, by spending too much on drilling, by bringing down global prices, because for a while they were producing so much that they actually did have an effect on global markets. They don't want to repeat that mistake, and they just basically want to turn the conversation to other topics, get it onto more comfortable ground for them. Because if anybody looks too closely what's going on, they'll be like, they're vulnerable to assaults on, say, like a windfall profits tax, like the U.S. industry used to have to deal with. So I'm going to say one more thing, that it's not just, I mean, the entire debate about oil and gas right now is kind of sideways from reality. And one of the things we've heard from the administration is, hey, the oil industry can grow, can boost production. It just needs to drill on its federal permits. And it's a little bit weird to hear an administration that campaigned on trying to curtail drilling on public land, saying now's the time to drill on public land. But I'll just sort of like lay out some facts here. Number one is, so this is a chart showing by year the number of wells drilled in red versus the number of federal permits issued, federal permits for drilling. And what you can see in 2020 and 2021 is this big gap between the number of permits that were issued for drilling and the number of wells that were actually drilled. I mean, there's always been a bit of a gap, and there was quite a bit of a gap in 2004 and 2005 as well. But the last few years, the lessons are, number one is that Biden actually approved more federal drilling permits than were approved under any year under the Trump administration, or frankly, since 2008, since the second George Bush administration. And the second thing is that the industry has, practically never been as indifferent to drilling on its own permits. There's this, probably one of the biggest ever gaps, at least in percentage terms, between the amount of drilling that's going on and the number of permits that were issued. So what's going on there? Well, the reality is that a lot of the permits that were issued to oil and gas companies were on lands that the oil and gas industry really doesn't want to drill on anyway. They were just in case. They were getting permits and particularly in Wyoming for some reason. They saw this huge boom in permits issued in Wyoming that were kind of untethered to the fundamentals of drilling there. Like, nobody really is ramping up drilling dramatically in Wyoming, but the Wyoming drillers wanted to make sure that they could get their foot in the door before the Biden administration shut them down. That's my interpretation of what happened. That there's a lot of permits in there that were just not really wanted. So the reality, of course, is that this whole debate about federal permits is a little bit off topic, because almost all of the oil and gas production, onshore oil and gas production in the US happens on private land. And that's a place where the administration has very little control. It's really the oil companies themselves who are in control of what happens on the private land, on land that they lease or own, and where they have it's basically state permits rather than federal permits. So I guess my point here is like, when you look at rhetoric versus realities, pretty much no matter where you look right now, you see a big gap. You see a gap between what people think is important, or what people are paying attention to or want us to pay attention to, and the underlying trends. And the real underlying trends, I think, have been pretty clear. This is an industry that was losing money for a decade. This was an industry that is, at the current moment, is enjoying high prices, and it's choosing not to drill more because it doesn't want to spoil the profits. And so I'm going to leave it there. And if people want to start talking a little bit about about Ukraine, and I'm open to any questions. Feel free to hop in. So
I would like to try to do this in some kind of orderly way. And I have questions, but I'll hold mine. If you have a question, would you mind raising your hand, and we'll call on you just to make sure everybody gets a chance. Mark and Kathy.
Yeah, we've been hearing a lot about this idea that gas prices rise like a balloon and then settle like a feather, as if that's some immutable law. Whereas surely it's got to be a decision by the oil companies to maximize their profits. I just wondered if you have any comments.
Yeah, I actually looked at this. I heard this, right? I heard as if everybody knows that they go up fast and they go down. And then I looked at it, and I did this thing where you line up oil prices with gas prices and try to find the best fit, right? And the best fit, how long is it between this? And I could not see the rockets and feathers. I mean, basically, the best way of describing it, gasoline prices, was what were oil prices like 9 days ago. That was, and so I think there is less there to the whole rockets and feathers argument. Like rockets meaning prices rise quickly when oil prices go up. I'm not sure I actually see that in the numbers. So I don't know what to say there. I mean, I can understand people pay more attention to gas prices than they do to oil prices. And so what you see is, oh my gosh, gas prices went up. And that's your reference point, right? Oil prices went up. And then you see gas prices went up. And you see oil prices fall if you're paying, because now you're paying attention because oil prices just went, and you don't see the gas prices fall exactly in the same pattern. And so you assume that gas prices went up with oil prices and they fell slower. But what actually happened was that they were I think they're kind of doing this, where there's just a natural sort of delay. And I'm not sure I can explain it better than I looked at this idea and I couldn't. Maybe people with better math skills or more time would be able to find it. But from my point of view, it's like, yeah, this is not, this is conventional wisdom that may actually be wrong, or where there's not a lot of there, maybe some, but, and you can also understand why, from if you're like say an independent oil company and you just bought your oil, sorry, let's say you're an independent gasoline station. You just bought your gasoline, you paid, $4.50 a gallon for it. You're going to want to get that $4.50 a gallon back, right? You're going to want to be able to say, okay, I need to be able to pay back, justify this $4.50. So I'm not going to sell it for $4.20 just because everybody else is. You can see that happening in some cases, but anyway, looking at the big picture from EIA, Energy Information Administration data, I didn't see it as such a huge deal, but it's a good question.
Trish? Thank you.
Hi.
Clark.
So
Hey.
I'm calling in from Eastern Montana. So I am in the thick of oil and gas production.
Yeah.
In fact, that is the industry I work in.
Yeah.
I work for a company working to reduce flaring and
Oh, neat.
any vapor. Yeah, so that's what I do now. Something that aligns obviously more with what I personally believe.
Yeah.
But I mean, one of the things that, and I apologize for the sound in the background, I've got dogs that decided it's playtime.
That'll be happening to me any moment now.
Right. One thing that is difficult to try to discuss with people in this area is specifically how the oil companies aren't making the money off these high gas prices. And I personally, it's how do you explain to people that no, these gas stations themselves are not funneling
Right.
buckets of money from you, but
Yeah. So it's the gas station issue, right?
Right.
So oil, like, I don't know if you can, like, maybe you can show them some chart. I mean, like, I don't think I understand anything until I made a chart about it. I actually named my daughters with spreadsheets.
There you go.
So, I mean, I hope it doesn't, that's not too weird. I mean, like, maybe that's the sort of thing I ought to be telling my therapist, not a group of
Nah.
people
The weirder
on
the
Zoom.
better, honestly.
Yeah. Okay. So, but so really, the gas stations they have a margin that they need. Like, the gas station itself needs to pay its people, needs to pay for its land, it needs to pay for its utilities. It has this thing, and so it basically it takes the amount that it pays for finished gasoline that it gets from a refinery somewhere, and then tax on a margin that it needs to survive, right? And so you may find that the gas station itself is, well, maybe they're padding a penny or two, or maybe they're trying not to lose volume. Maybe, like, a gas station, for example, might, maybe it has, it's like a convenience store attached, and they want people to come there and stop in and to use the convenience store. So maybe they're going to try to actually squeeze their gas margins down as much as possible to sort of entice people to come in. So, I mean, the drivers of gas costs, the fundamental drivers of gas costs are the cost of oil, that's most of it, the cost of refining, the cost of getting the oil from the refinery to the station, and the margin for the station. And of those, it sort of depends on where you are, but those are the small things, and those the margins for the station,
Right.
and the margin for the transportation. That's kind of small. It's not the gas stations
Right.
that are profiting; it's
Right.
the upstream. Now, one of the things that's very interesting that's been happening recently is, in addition to higher oil prices, which basically means more money basically sucked out of consumers' pockets and funneled straight to Wall Street. That's what it is. You just sort of imagine it's like it's a vacuum cleaner, and they're sucking your money and they're sending it to Wall Street investors. That's what they're saying. That's the system we've decided to have. Like, this isn't like sort of a matter of price gouging or something. Maybe it is. I don't know. That's what you mean. But, like, the market price is this, and it means that, we've been essentially, Wall Street had been subsidizing consumers for the last decade by pouring money into an industry that was losing money. And, so prices were actually too low. you know, from their point of view. And now the prices are high and they're actually making money. Like, well, maybe that's, you know, is a quid pro quo. I don't know. I mean, it's just sort of the weirdo system that we decided to have. But but so the other thing that's happening right now is that refiner margins are widening out. That what's called the crack spread was one of those funny words in the oil and gas industry. The crack spread basically means the difference between what you can buy oil for and what you can sell your products for. That crack spread has been widening. And part of that may have to do with the sanctions on Russian oil and oil products. So we like to think about oil as if it's all just one thing, like oil, just oil. But and you're probably aware of this, but like there are all these different grades and there's qualities of oil. There's like some that's high sulfur, there's stuff that's like sort of thicker and sludgier, like almost like tar. And there's stuff that's almost like, you know, it's like salad oil, and everything in between. And so the US refineries are mostly set up to handle heavy oil. When they were built, especially along the Gulf Coast, the future of oil was going to be deep water Gulf of Mexico. It was going to be Saudi crude. It was going to be Venezuelan crude. That's all heavy stuff. So all of our refineries, or many of our refineries, are set up to handle heavy crude. But what we're producing with fracking is light crude, because that's what can come out of the ground, flow out of the ground easily. You've frack these things underground. They're getting what. So what we're doing is we're exporting the light crude. We're importing the heavy crude. That's one of the reasons that our oil system is tied into the global economy. And then, so I'm babbling here, but so the fact that Russia has, you know, Russian oil is no longer welcome in the US means that all of these refineries that were configured to handle either Russian crude or Russian, what's called heavy gas oil. It's heavy vacuum gas oil, but there's this thing, lightly processed oil that gets used in certain refineries. They're having to reconfigure, they're having to find new supplies. And so that means that the remaining refineries, maybe they're under higher demand or higher volumes because, you know, like so there are some places that
have to go somewhere.
Yeah, exactly. Right. So anyway, the long story short, right now, it's really the refiners who are making a little bit of extra money right now because of the crack spreads are wide. And the oil companies themselves that are producing the oil and gas. Right. And so basically oil companies are making the money. It's not the guy at the who owns the local. Right.
Yeah, that, I mean, that makes a lot of sense. I don't know how I will explain that to anyone else, but
well, I mean, there's actually the EIA, Energy Information Administration, might have some explainers on this. Just sort of simple, like here's a chart, here's a, and sometimes it's like this much goes to the oil company, this much goes to the refinery, this much goes to this, and really it sort of breaks it down pretty simply, and you just say, it's these guys who who are kind of have this little bit of like it's hard for them to, they could be like doing worse now because their volumes are going down, people are buying a little bit less.
Clark,
well, in terms of that,
go ahead.
Sorry, I was just going to say, in terms of the profits rising in 2020, I know that what we saw a lot around here was a ton of layoffs. So they really, really minimized their employment.
Yes. And
then they put on extra jobs onto those people instead of replacing them now when they could.
That's
so
a
it's all
great way to make money. Fire people, right?
Yeah.
Like, if you're a company, if you and actually, frankly, maybe it was necessary at the time. Like, this is an industry that has never made money, and they thought maybe this is there's all this talk in 2020 about sort of the death of the oil industry because they'd had a dismal decade, and then it was capped off by COVID and demand dropped, and so everybody layoffs and bankruptcies and frac sand companies folding and all sorts of other stuff. Yeah. So, but that was the.
I'm gonna.
Yeah, go ahead.
I'm going to interject because we do have some questions.
Oh yeah, of course.
And I want to make sure we get to them. I'm going to ask one that that's been sitting in the chat for a little bit. What about the EU buying mostly Russian gas instead of our exports? And Patricia, if you want to expand on that, you can. Clark, do you understand the question?
I think so. Is this gasoline or natural gas? Patricia.
I mean oil products,
Oh, okay.
whatever that includes. There's a market out there that the oil companies in the United States or they're worldwide could be providing all of the oil needed for the EU countries because they're dependent on Russia.
Yeah, that's starting to happen. So far, the European countries haven't banned oil imports, although they're starting to talk more about it. As the wars progress, they've started talking more and more about getting off of Russian oil. What's happening now, there's a weird thing that's happening for Russia right now. It is still able to get a lot of its oil out into the market. It's selling to India, it's selling to China. And so there's this big reshuffling of the deck chairs, where stuff that was coming from Russia we were selling to China, and Russia was selling to Europe, and now the flows have been kind of reversed. And so there are two things that are happening with that. One is that Russian oil is selling at a discount, so that Russia is not getting as much money for its oil as there's part of the reason for high oil prices right now for all of us is that Russian oil is selling for less, and all the other oil, countries are competing a little bit, for that supply of non-Russian oil. The other thing is that because of high oil prices, even though Russian oil is selling at a discount, they're still making a lot more money than they were before the war. War has actually been good for their revenues, it appears, which is kind of weird, unsettling. But you're right. I think that what's already happening in the market is that there's a significant amount of U.S. oil, sort of a reshuffling of global supply chains where we're supplying. But the question that I actually don't know the answer to this is whether European refineries are really set up to handle U.S. oil, this light oil. I don't know. I don't know the answer to that.
Thank you.
Of course. I see Sarah and Will.
Will is the next one. He's been up there for a while, and then Sarah.
Okay.
Yeah, Clark, I got a question for you, but first let me say this is just really fascinating. I've learned.
Thank you.
But my question is, how do electric cars figure into this? Because I would think at some point the oil companies and their investors would be concerned about driving car customers to the electric car market.
Absolutely right. That is happening. It was happening anyway, but it's happening more now. You've seen spike, there's signs all over the place, spikes in sort of Google searches for electric cars. I think that Tesla, which is not a company I'm particularly comfortable with, but for a bunch of reasons, but Tesla's I think the waiting list went from 6 months to 3 years. I mean, that is happening. People are now, what's called sort of accelerating demand destruction. They are turning to alternatives to oil and gas, not just for political reasons and not just for economic reasons, but the combination. Oil is now there's some stigma attached to it, and there is, and it's an electric car is just cheaper to fuel. And in many cases, if you count, fueling and operations, it can be cheaper overall, although people debate about that. So I think that's happening, but it's not just happening in the US, it's actually happening more overseas. And we're seeing, Europe, the demand for electric vehicles is a lot higher. We're seeing a lot more electric vehicle demand in China. Some of that may be replacing motorcycles, like little tiny, small electric vehicles that, are kind of moving into the motorcycle market. But in general, you're seeing, this sort of accelerating shift towards electric vehicles that is going to be bad for demand for the oil and gas companies. And, it's a time, it's actually kind of dicey for them. Russia is going to be moving hard off of gas. They're going to be conserving more, natural gas. There's demand destruction happening in natural gas in Asia because prices are so high. oil prices are high, and 10, 15 years ago, this didn't matter so much, but now because electric vehicles exist, because renewables and solar, wind and solar are pretty cheap, because storage is getting better, when oil prices are high, when natural gas prices are high, that actually does create demand destruction. And when that happens, you're essentially, when you buy oil, a year later, you have no oil, like you burned it all. When you buy solar, a year later, you still have the solar. So all of these shifts from wind to solar, or from wind, not wind to solar, but from oil to solar, or oil to wind, or oil to storage, those are all cumulative. They stack up over time. So as this shift happens, the electric vehicle shift happens, it's not just a demand destruction in 1 year. Those electric vehicles are going to be on the road for 15. And that's going to it's going to start to add up globally.
Thank you. God, what great questions, everyone. Thank you so much. Sarah?
Oops, can't hear you.
Thanks for taking the time. Can you hear me?
Oh, no, of course.
Okay. I am a substitute teacher in Billings, and I was subbing a substitute, or subbing a social studies class.
Yeah.
In middle school, and they were, the stuff that they were working on. It was it was like a discussion thing about current high prices, inflation, high prices of gas, stuff like that. And I was a little curious, and so out of curiosity, I asked, "Who sets the gas prices?" And it terrified me, the amount of students that said Joe Biden. Yes, from the classroom, telling you, kids around here think that Joe Biden sets the gas prices. So I wanted to ask if anybody has, like, this is such a complicated topic that, like, easier, like smaller, like easier to digest bits of information. Is it's kind of tough to construct for people that have lower education, may have dropped out of high school, or students that haven't finished their education and are getting a lot of distorted facts from home. So I don't know. I was just kind of asking if you guys have any like overall, like, because the way I handled it in the moment was just asking the questions and saying, no, that is wrong. Try again.
So, one of the things that's fascinating about oil prices is that people do blame politicians for oil prices, right? Which is the weird thing about this in particular, is that in the American system, I mean, politicians are almost least to blame. Not to say least, but we've essentially turned over the pricing of oil. The way it is in other countries is, actually it is a political decision. Like the politicians decide how much the oil price is going to be, how much consumers are going to pay, and they make, and the public, the government makes up the difference. And so, like a place like India or Pakistan, there are subsidies for fossil fuels. Consumers don't see the prices, so they don't have, they don't respond to price signals, because it's really the government that gets on the hook. And this is bad because Pakistan, for example, this is not going to help you in Billings, I'm sure, but but they're facing serious fiscal problems because of their subsidy regimes for basically subsidizing fossil fuels. We don't have that here. So oil prices in the US are about as close to a free market, sort of free market, the free market ideal as you can get. It's not somebody in Saudi Arabia deciding what the oil price should be. It's a bunch of sweaty guys yelling at each other and tapping on a computer and like sort of upvoting oil, right? And somebody downvoting oil, and they're all, it's all basically buyers and sellers who are either purchasing oil for themselves, selling oil, or it's it's people who like, let's say, an airline, or a speculator, but an airline that wants to sort of guard against high prices in the future. So they'll bid, do things in the futures market, the oil futures market. So it's really, I mean, the oil price, unlike, like an Apple iPod, some guy in Apple, probably a guy, I don't know, but decides what the price is. we're going to sell this one for $6.99, and our profit margin is going to be $1.39. That's our price. In oil, for commodities like this, it's actually, it's closer to a free market than you have in just about anything else. And so when people complain, essentially they're complaining about the free market. When they complain about oil prices, they're complaining that the free market doesn't work for them. And
The irony.
but yes, right, the irony, is because if you don't like the free market doesn't really care whether it's whether the oil companies are making a profit. It doesn't care about whether consumers are hurting. It just doesn't care. It just produces a number, and the number is based on a bunch of people representing their own interests and doing this nonstop virtual auction. It used to be set by actually literally a bunch of sweaty guys in a mosh pit on Wall Street who were just yelling at each other. And that was how the oil price was set. They're buying and selling, and there was all willing buyers and sellers, and there's a big super high pressure ADHD environment with people who would hyper focus and blocking everything else out. But then anyway, super interesting book on this stuff I read. Bottom line is, if you don't like oil prices, then you don't like the free market, and that's your that's closer to reality than not.
Well, thank you. That actually helps.
Yeah. Okay.
Thank you. And thank you, Sarah. I'm going to interject my question here. And I know there's a couple more people, but Clark, last week, Biden issued an executive order, and part of that executive order to try to ramp up production was a use it or lose it for these companies. Could you speak to that a little bit? It seems like a bit of a double-edged sword for us.
Yeah, I don't know. So with that one, so I don't know what's going to happen. I don't know what the results are going to be. Part of the use it or lose it idea makes me feel like they're probably just going to lose it, because a lot of these the permits. When you look at the geographic distribution of where the permits actually were, which is something you kind of need to do, the big production center on U.S. public lands is New Mexico. It's the Permian Basin in New Mexico. That's where most of the most productive, most economic wells are. The big place where a lot of the permits were issued, it was like Wyoming and maybe Colorado. I don't know what it was, but maybe I don't know. I'd have to take a look. But these are places where drilling is less advantageous. Right. And also public lands, are going to be concentrated in different states. There's not a lot of public land in Texas. There's a lot of public land in Wyoming. So you're going to see more you're seeing more permits in Wyoming than you are in Texas, just because that's, even though Texas is big, very little federal land. So anyway, you wind up potentially with, people applying for permits for, companies might apply for permits for reasons having nothing to do with their production plans. They may be just like to say, we have lots of permits, we've got a lot of running room. They're doing it to attract investors. They're doing it for all sorts of reasons other than they actually plan to use that permit. But so a use it or lose it could mean an acceleration of drilling on sort of suboptimal, the places that aren't that great economically to drill. Or it could just mean that companies that kind of bought just in case permits don't use them, and those permits go away and they have to sign up later. I don't have a strong intuition about how this works for or against conservation interests. I don't have a strong intuition. I don't want to say anything too much before I.
Feels like it cuts both ways.
Before I make a spreadsheet or two.
So we're at the ending mark, but there's still a couple more questions.
I'm fine. I'm good to go.
Respect everybody's time. So if anybody feels the need to jump, thank you very much for joining. We're going to do this again. Next time we'll talk more about what MEIC is doing on fossil fuels, oil, gas, coal in Montana. And I'm glad we didn't get to it because this has been absolutely fascinating, Clark. I
good. I'm
really
glad
appreciate the time you're giving.
And I can stay on for a little bit longer if people have questions. I tend to run on a little bit. I get excited about this stuff, so I apologize.
I get it. I sympathize. I do too. So thank you all, but let's go to Mark with his second question.
Yeah. Hopefully this doesn't open a big can of worms. I'm just curious what you think of, even if there weren't supply chain constraints, do you think it would be difficult for oil and gas companies to ramp up their drilling? And the reason being that they're in mature basins where the sweet spots have largely been drilled already, especially with fracking, the initial production rates are dropping and the decline rates are high. So maybe, maybe they really can't bring up production enough to reduce prices anyway.
That's a really good question. So I can't speak for every basin. I did a deep dive into the Bakken, which is obviously spreads out into it's mostly in North Dakota. It does spread out into a bit of Montana, but most of the drilling is happening in North Dakota because that's where the sweet spots are. So what you can see in the Bakken is that the sweet spots are almost drilled out. The best wells are, like, most of them have now already been drilled. The places with the highest concentrations of hydrocarbons underground, and there's no way they can, that's tapped out. And you also see that there is a relatively big gap between the best places in the Bakken and, say, the middle quintile, the top quintile and the middle quintile, in terms of how much money do you need to, like, what's the price that would justify drilling there? Just saying, I don't actually think these numbers are the wrong metrics, because you can have a company that drills wells that break even, but the company is still losing money because of all the corporate overhead that goes into it and some other stuff. And so we saw all these decisions for years, people drilling break even or better wells and then losing money in the process because they weren't actually break even. But let's say the break even, let's call it 45 for a good top quintile well, and there's some left, but not many. And then for a middle quintile well, the break-even price might be 59 or 60, right? So there's a big gap between the good and the middle. The issue, though, is that there's still a lot of wells that are in that sort of what would be considered middle quintile. The middle quintile is like middle quintile compared to all the wells that have been drilled so far to date, but there's still a lot of remaining drilling sites in that place. So if oil prices stay at 100 for the long haul, you could imagine a scenario where a lot of these additional drilling sites do make economic sense in that you got a long-term futures curve at $100 a barrel, and you've got oil that breaks even at 60. Well, even if it's not, even if it doesn't really break even, the gap between 60 and 100 is big enough that the company can wind up making a leap. So, but this is a long way of saying, high oil prices, if high prices stick around for a long time, that starts to change the decisions about what people can do in a place like the Bakken that is mature, where the best places are drilled out, but there's still some inventory, lower quality inventory, and there's a lot of it. And you could imagine companies deciding, well, we can make some money doing this. Now, so that's the Permian. That's also, the Bakken. It's the Bakken. It's also probably the Eagle Ford in Texas, possibly DJ, maybe Green River, some other places that are sort of oil-focused fracking basins that are kind of mature, never really panned out, Scoop Stack in Oklahoma. But the Permian is kind of the place where there's more top quintile drilling sites left, and the gap between the top and the middle is not so wide. So in like, in the Bakken, you get outside the sweet spot and suddenly you're in a much different economic place. The sweet spots are good. There's good as places in the Permian, but your third quintile is pretty crummy. But in the Permian, your top quintile is good, but your third quintile is better than your third quintile in the Bakken. So this is one of the reasons I think we're seeing the oil industry switch from places like the Bakken to the Permian, because it's not just like, there's more top quality drilling sites, and even the non-top quality drilling sites are better than places like the Bakken. And of course, with the Bakken, you have to worry about, like, are you going to fill up the pipes? Do you widen out the differentials between the hubs in North Carolina, in North Dakota, the pricing hubs, and West Texas prices? But the if prices stay high, I could imagine another resurgence in production. It probably would be kind of the last one, but you're right that the industry is facing constraints it did not face 6 years ago, or 8 years ago, when it was like, in 2014, when they're deciding, what do we do now that the oil prices have fallen? They still had some inventory left, and now they don't have as much inventory, so it gives them less running room and less flexibility to ramp up long haul. But it doesn't mean they can't ramp up at all if the prices stay high, because high prices do magic. And I can't hear you. Oh.
Yeah, thank you. I see that CC is still on. CC, do you want me to read the question you put in the chat, or do you want to? I will go ahead and read it. So she asked, what's going on in the South China Sea, and are we drilling over there?
That's a great question. I know it's really tense over there. I don't think we're drilling, but I don't know. I'm sorry. You've like, I always promise myself I'm never going to answer questions that I don't really know, and this one I really don't know anything about. So sorry about that. It's a great question.
Clark, it is shocking to hear that you don't know the answer to something. So
please.
It makes me feel better.
No, goodness gracious, I know so little.
Oh, you know so much more than all the rest of us.
That's well, I mean, about this maybe.
That was the last question I saw in the chat. If anybody has any more questions, or if I missed something in the chat, go ahead and unmute yourself and feel free to ask a question. Will, you look like you're teeing up.
I was just wondering if we could possibly get a copy of this presentation. I would like to share this with others.
Sure, I'd be happy to. I have to fix the errors. Millions to billions, like $1,000, being off by a factor of 1,000. I don't want to have that go out into the world. Also, I'm pretty sure it's Pioneer Resources. So those are just the errors that I caught as I was running through it myself. So, but yeah, I'll fix the errors and I'll send stuff to Anne, I guess.
That'd be great. Thank
you.
Distribute this.
Katie will work her magic, and we'll make sure we get it to all of you, and we'll put it up on our website.
Yeah, and I can maybe share it as a PDF or something like that.
And just to note, I put my email in the chat, so please email me if you'd like a copy, and I'll make sure you get one.
Great.
Well, wonderful.
Else? Any other?
It's really good to see you guys. It's nice to actually have a conversation with humans for rather than my with an Excel, my spreadsheets.
You yell at your computer too, eh? Thank you all very much. We're going to be doing something, along these lines, another webinar, but not as smart and well informed. Just something on what MEIC is doing in a couple of weeks. But for now, I would just like to thank Clark for giving us his time at the end of the day.
Yeah.
Super appreciate it.
Of course. And of course, you know, again, I mean it sincerely. You guys are my heroes. Thank you for everything you do. So take care. Bye.
Thank you.
Thank you.
Thanks, everyone.